guys like Michael Widmer, who is the Bank of America's head of metals research, saying silver could reach anywhere between 135 and 309 by the end of this year. Maybe that's the reason that we've been seeing so much in the way of deliveries into the COMEX, month over month over month over month over month. Every single month, we are seeing massive deliveries.
Gold experienced an unusual event on Monday, March 16th. It plummeted toward the $4,900 mark, its lowest level in a month. Even as an active conflict ravaged the Middle East, the Strait of Hormuz remained partially blocked, and oil traded in the vicinity of $84 per barrel. By Tuesday, March 17th, the yellow metal had recovered above the psychological threshold of $5,000 to trade at $5,016 per ounce. However, the movement observed the previous day revealed a fragility within gold's bullish rally, a fragility that the precious metals community cannot afford to ignore. The very forces that propelled gold from $2,600 to over $5,400 within the span of 12 months, a weak dollar, expectations of accommodative monetary policy from the Fed, and central bank purchases are now operating in reverse, at least temporarily. According to Andy Schectman, silver can reach $300 by the end of 2026. Before we move forward, if you want to stay up to date on the latest gold and silver news, you can subscribe to our channel and like this video. Now let's get back to Andy Schectman's view on gold, silver, and the overall global economy.
The wisdom of holding your wealth and your excess cash in gold, to me, is extraordinary. But let me just show you quickly. 2005, I can pick any number, but 2000, I've said this so many times on podcasts, I remember it. 2005, the average price of a house in the country was $240,000. Gold was $455 average price in 2005. That's 510 ounces or thereabouts. You could have used that 510 ounces to pay off the house. You don't. You put it under your mattress, earning nothing but dust. And that's what, the financial, well, it doesn't pay any yield. Why would you own it? Okay, fair enough. The house has doubled. Today it's 500,000. Great investment. You did well, right? But those 510 ounces today times roughly $5,200 or whatever, you're talking $2.6, $2.7 million, which buys you 5 fully furnished houses. So your house doubled in dollar terms. It lost 500% or more in gold terms. In other words, the dollar is falling faster than assets are appreciating. Gold is what exposes that. So yes, I think the most important thing to do, whatever you do, is realize that the very, very wealthy people, they hold their wealth in assets. Assets will feed you. Liabilities, which is what a dollar is, will eat you. I think that the paper price is the greatest tool of misdirection, and I don't think people quite understand that. And what I mean by that, let me try and give you what I mean by that. And let's use gold as kind of the proxy for understanding that. Gold is like, for example, GLD, which is a proxy for the price of gold. But to me, it's functioning more as a deliverable reservoir. And so what's interesting about it, the big interests in the U.S. do not need to telegraph physical demand by bidding loudly in the open spot market, because that's what a lot of us can analyze. That's what we've been talking about. But what they can do, and these big money interests would be the APs, the authorized participants, JP, Goldman, et cetera. They can source GLD shares and redeem what's called baskets, which are 100,000 shares minimum, through their channels and receive London good delivery bars. So
you and I can't do this, but these very big players can, right? Yeah.
Right. And so what we saw recently was a very, very large redemption coming out of GLD.
Gold has initially surged from $5,296 to $5,423 when Iran issued threats regarding the Strait of Hormuz, an instinctive safe haven reaction. Subsequently, it executed a sharp downward reversal, shredding more than 6% from that intraday high over the course of just a few trading sessions. The dollar index recorded a marked rebound, climbing above 100.2 points, its highest level since May 2025, thereby making gold considerably more expensive for buyers using currencies other than the dollar. A stronger dollar raises the cost of gold for investors holding other currencies, consequently exerting downward pressure on the precious metal. This rebound in the dollar is, in turn, a consequence of developments in the oil market. The closure of the Strait of Hormuz pushed Brent crude prices toward $84, thereby rekindling inflationary fears and reducing the likelihood of a Fed rate cut in June. The surge in gold prices, which climbed from $2,600 to $5,400, was largely predicted on the expectation of a decline in bond yields, coinciding with rate cuts implemented by the Fed. This thesis is now being called into question, and gold prices are readjusting accordingly. The situation for silver mirrors that of gold, albeit with the heightened volatility inherent to its industrial nature. Monday's trading session marked the fourth consecutive day of losses for silver. The white metal fell to $77 per ounce, its lowest level in a month, before rebounding to close on a barely positive note, up just 0.2%. Tuesday's session appears so far to be following the same trajectory. Silver gave up 0.15% and was trading just above the critical support level of $80. Silver's current pullback does not constitute a mere temporary correction, but rather reflects a deep reevaluation of market expectations regarding the trajectory of U.S. interest rates, the most decisive short-term factor for non-yielding assets. The analyst notes that the fading of rate cut expectations is reshaping investor behavior toward alternative assets as the opportunity cost of holding the white metal rises in a monetary environment that still offers relatively stable or positive real yields. The analysis of the January rally, which projected a gold price of $6,000, as well as the forecast of a $375 silver price, were both based on the premise of persistent dollar weakness and monetary easing. This premise was put to the test in March. An influential voice in the precious metal sector is sounding the alarm regarding a growing disconnect within the gold and silver markets, arguing that an unstable level of fiscal irresponsibility on the part of the U.S. government is setting the stage for a major systemic correction. This analysis comes from Andy Schectman, who exposes a concerted effort to depress the prices of paper contracts even as physical demand reaches historic levels. Mr. Schectman highlights an intense battle being waged at this very moment within precious metals exchanges. Despite a recent pullback in prices, physical demand for silver remains astronomical. He notes that the volume of physical silver delivered by COMEX in October is on track to rank among the top 3 delivery months in history. The battle currency being waged in the markets indicates that the countdown has begun for a system struggling to preserve its solvency and the confidence it expires. That's all for today. Let us know your views in the comment section below, and don't forget to like this video before leaving. Thanks for watching.